So stocks broke out today to new all-time highs. Got some really good bullish signals on multiple different technical indicators today, kind of solidifying this current trend that we're on, avoiding any failure of this trend, a break back down. At least now, a break back down to potentially new lows. So I'm going to break down what those signals were. A really good bullish, and like I said, multiple indicators showing us good signs today. A new gap formed today. We'll talk about which one of those and how likely we are to fill in this morning's gap sooner rather than later. So we'll talk about that as well. We'll take a look at the red flags that are still out there that might limit the upside that this intermediate trend has in terms of whether or not we might mimic that 27% return we just had, or even in the high double digits, in the high teens. So we'll talk about what those red flags are, but what we kind of need to see, hopefully sooner rather than later, in order to get rid of those red flags. We'll break that down as well. One of those being some of the moves that we're seeing in the sector rotation. Today's sector rotation, on one hand, was pretty strong. On the other hand, it had a few question marks. So I'll show you that. How different asset classes are performing. Some very important levels on the dollar and the 10-year yield that we're sitting on right now, as well as commodity prices. We'll take a look at how significant those levels are, the kind of pivot points that they're at, and what the impact it might have on our expectations for this current trend. And then we'll take a look at our trade idea, a stock that's in the bullish technology sector that kind of broke out of a multi-month sideways trend, albeit at bullish levels, but multi-month kind of ascending type triangle pattern. And we'll talk about how to trade that. So let's go ahead and get started. Today is Wednesday, May the 15th, 2024. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get going too far, I invite you to subscribe to our YouTube channel. This icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out some of these other things over here on the right, including our Market Outlook live video, where this is where I review old trades, take a look at trades that we can get. In fact, we got out of one of our older Market Outlook trades today. We put on today's trade already before the market closed. Come down to the bottom, click this heart. It opens up this tab. Hit that like button there. Same thing here. Click on this thumbs up icon. It opens up this tab. Hit that like button. Again, the more you do that, helps get our content out to all of our followers on those platforms. It's a big deal to us. That's why we always ask. So thank you to those who do this day in and day out. Those who don't, you can do it right now while you're watching with one or two really easy clicks. We can get our goal of 100 likes on our Market Outlook tweet. All right, let's go ahead and get started with the S&P 500, looking at the S&P with the market forecast indicator. And you can see we finished today with a overbought cluster, which is actually a good sign right now. When you get an overbought cluster at the beginning of an intermediate trend, when your intermediate line's just now rising in the upper reversal zone, that kind of solidifies it in the reversal zone. You can see we kind of came close, had the same idea over here. It means you had a really good run. We're up 3.5% above the moving average now. Market sentiment's still falling, but at least, again, like I said, we're above it. So that's a very good sign. Dark green shading the green line now. We got that for, today. Today is the first day that we actually had both dark green shading the green line with the cluster. Like I said, very good sign. Momentum line strong, near-term lines up above the 90th percentile. Really kind of solidifies and keeps us from having that failure move. I talked about a little bit about this today in our technical analysis class. The idea of getting this number in that 5 to 7% number. You can see it's not going to fall below 6.86. So we know at least we're going to get an almost 7% return on this current rally. But a 5 to 7% return typically marks a failure, and most likely a return to this low, if not lower. Something like this, for an example, when you get a 6% rally, and that's it, right? We don't get a strong enough rally to overcome the pullback. Same thing over here on this 5% drop or 5% rally that we had. Again, not enough. 7% rally, not enough. Even this 11% rally wasn't quite enough there to get us through. So 6% is not enough. Typically sets us up. So now I think with what we're getting here with this cluster, we have the likely scenario that we won't get a failure here where we will break down like right now to this low point, if not to lower lows. So good sign. Now that doesn't mean that it'll still be a weak intermediate posture, as we'll see here a little bit later. But at least again, we're not going to get a failure here like a bear tag failure like we saw here or even over here. We are definitely breaking through this bear tag. If all these other days of very small ranges, but slightly higher, but very small ranges weren't enough to convince you that this bear tag was bullish, now we have the convincing, right? The breakaway gap above prior highs, and then the rally up to the upside. Looking at your NASDAQ 100, you can see we also got a cluster on the NASDAQ 100. Again, very good sign. Not a good sign to get a cluster when you're multiple months into an intermediate rally. Very good sign when you're very first starting out. Again, same kind of idea that we had over here. If you look at the Dow Jones Industrial Average, you can see here that we also got a cluster. Near-term line barely, the momentum line is the one that actually got up to extreme highs. The momentum line barely getting there. Again, all-time highs, almost at 40,000 there. So good level there. Again, good sign to get it right off the bat. Again, very similar to this type of pattern that we had right off the bat over there. We're 3.5% above the moving average as well. Very, very good sign. And then finally, your Russell 2000 did not quite get the cluster because it's been behind. It's not quite at all-time highs yet. It's been lagging here. But your intermediate line is close to crossing up above the 80th percentile. You have very strong near-term sentiment. And you are over 4%, 4.25% above the moving average. So again, dark green shading and a green line across the board, clusters on these large cap indexes at the beginning of intermediate rallies. Again, increases the odds, not to 100% because nothing ever is 100 or 0% in technical analysis, but to a very, very high percentage that we're going to avoid a bear tag failure here and a move back down to lower levels, so to at least this low, if not lower. Let's take a look now at the weekly chart, and again, we're now 3 days into this move, and you can see a very strong. In fact, we've got the highest close. This is the highest Hakinashi close that we've gotten now in this past year. Much higher close than what we got last week. Easily a higher high. The PPO, or the Hakinashi differential is above its moving average still, so that's a good sign. PPO is turning back up again, all bullish on this chart. That's about everything bullish you could possibly want there. Obviously, we have 3 green arrows across the board. And as mentioned, we have a green line now, which needs to go with those 3 green arrows. In fact, even the MACD histogram's all turned up today on this renewed momentum up to the upside. So very good from that perspective. From a 2-line perspective, you can see the 8 and 17 have already crossed up above. The histogram is still not very strong compared to others, but now the MACD at least is at much higher levels than what we've seen. So that's a good sign. Usually, remember, the MACD peaks after the histogram, so we might be a little close to the peak here, but the further we can get up, the more likely we are to maintain this bullish trend. Because you're going to eventually it's going to roll over and start to converge, and the higher it is when that happens, the better off we are during the convergence. You can see during this convergence, you still kind of pushed up higher. Even though the MACD peaked and went down during that time, the index went up, right? And that's it's not the same momentum. It went up a lot slower, but at least it kept going up to that point before it had this new leg higher here. And then even from this point, when the MACD peaked and then kept going down, you can see the index kept going up. Again, much slower than what it had previously, but at least it's in the upward direction, still above moving averages, like we're seeing here. I mean, we are well up above. If you look at where we are relative to, say, like the 17-day exponential moving average here, we're pretty far up above that. Again, we've been further, like earlier in that cycle, we were up there on that gap there. Here on this kind of early peak, we got up pretty decent. This is a pretty decent level. If I were to zoom out for a little bit more context on just how high that is, if you follow my cursor all the way over to the left, you can kind of see there's been some other instances, but this is right up there. Outside of coming off that COVID low, of course, this is right up there with how strong of a move, that strong stochastics, even its moving average is up near the 100th percentile now, at the 96th percentile. Very strong move there. Let's look at some of these other oscillators. We finally got a bullish pattern on the DMI, so we're now above 30 and below 20. Above 30 on the positive indicator, below 20 on the negative. That's a recipe for a rising ADX. So very, very good sign there, finally. As I mentioned here, kind of getting that overbought cluster, and this signal is kind of, there's multiple signals that we've been getting here lately. You can see we're actually almost above 70 on the RSI. That's how strongly bullish we are here. We are above 100 still, though appearing like we might be setting up a little bit of a bearish divergence, but at least we're still in bullish territory there. The Ichimoku cloud finally switched to a intermediate trend strength. So we had been no trend forever. Finally got up to a weak bullish trend yesterday, and then now today up to an intermediate trend strength. Again, that's once you get to that level, you're a lot more likely that you're going to have a trend develop and continue and potentially go up. Now, most likely won't go up to as strong as we had here, but if we can get it up to as strong as we had over here, then again, that can lead to a pretty decent run. Finally, another pattern we finally got today. Even though, again, we're not pushing up against the upper band, we're still not even in the 90th percentile yet, much less, up above that band or pushing up against it, even with the Bollinger Bandwidth as high as it is. Momentum here is rising still, but you can see we did close outside of the Keltner channel, right? So finally, the first time, so that overbought cluster, closing above the Keltner channel, getting that bullish signal on the DMI, getting the trend strength indicator showing intermediate trend strength. All those things happening today, again, really reduces the odds of a failure here. And again, when I say a failure, I mean a move on the zigzag chart of about that 5 to 7% range. Remember, you don't get a green tag until you get at least a 5% close the close move to the upside. But even though you get a green tag, doesn't necessarily mean that we're going to trend higher. Anything in that 5 to 7% range tends to lead to failures, and so I think we have a very good shot at avoiding that with what we're seeing with today's kind of breakout move here, with that little bit of a breakaway gap that you can see when you look at the intraday chart. When you see a gap up here, if I were to zoom out a little bit here to go out to see the prior highs. Here, let's zoom in to a 30-minute chart maybe. Yeah, so you can see. So here's where the old highs were. If you follow my cursor all the way over to the right, we gapped above those highs today, and then just ran away from the open. So that is not a runaway gap, but is a breakaway gap. When you break above resistance overnight, or in this case early in the morning, and then stay above it once the actual market opens. So higher high, higher low, both above yesterday's high and easily above last week's high. And you can see obviously a new 4-week high point, so we're still at the 100 level here. In fact, you can kind of see that similar to what we saw when we first got the breakout there. We had new highs for multiple days in a row before you started to slow down a little bit. But we're seeing there, you can see the size of the channel width is up to a pretty decently strong level. Not as high as we got when we first broke out there, but still pretty decently strong level. Obviously the range was actually a little bit above average today when you account for the gap, right? Remember, we had about a 2-point gap almost. So when you account for that, we're a little bit above average, actually pretty decently above average on the gap. The ATR on a relative basis is down below 1%, which is actually a good sign. It's okay to get a pretty decent gap when you're breaking through like an old high point like this. Now we can start to slow down because, again, the trend really develops when you get below this 1% mark and you stay, below the 1% mark. So we're below it a little bit now. We just need to continue to stay. One little bit of a red flag, again, that we have. Again, I don't think we're going to fail here, but in terms of a week, kind of in that 8 to 10% range where we have a weak bullish trend to the upside. One that gives you probably more than a 38% retracement once you do get one. One sign that's a possibility is volume being so low. When we came off of these lows over here, you can see volume was still really high and had a lot of room to fall. That's not the case right now. We are already down to, easily down the 52-week lows by a large margin. So very extreme from that perspective. And then, of course, when you normalize that volume and look at it on a money flow basis, you can see again we're just not up to these old high points. So if I were to activate this and move it up to the actual high that we had in the money flow, which happens to correspond with like this peak right there, obviously we are well above that peak, 529 versus 514. But the volume still is nowhere near its peak. So despite the rally we had with very little volume and then the decline and then subsequent rally we've had since, we're just not able to get. I mean, the last peak of volume that we had is this peak that we're still below, and you can see that corresponds up to this price. We're easily above that price by about 10 points, and again, we're still below that on the volume. Even with the oscillator at bullish levels, the money flow has not been there during this little bit of rally. Now that might fix itself here if we get a couple good, stronger days of volume as we continue higher, or it can really exacerbate itself if we now after this breakaway start to really get lighter volume again. If we take a look, see, I also didn't show this chart on the intraday chart. Again, we are well up above now the 90th percentile, so that was a good breakout we got last week. Now the average itself is almost in bullish territory, which will be kind of another sign that we're not going to fail. I see this, we didn't get up there on these failures, and we broke back down below that. So unlikely we're going to break back down below that average before it crosses into bullish territory. So that's a very good sign as well. One other little bit of a red flag that we need to pay attention to is, we are sitting here at the 200-day haul. We failed there last summer, so we kind of need to break through this, kind of like we did over here in late 2023, and that helps solidify that trend, turn it from red to green. Now we never did turn red, but it'd be nice if we can get this line, this PPO, to up above zero and keep it there. Right now it's got its toe dipped up there. But we'd like to keep it up above zero and really kind of make a run up to the upside. All right. Finally, it's one other red flag, again, that won't necessarily lead to failure, but could definitely lead to a weak intermediate rally to the upside is the VIX. The VIX is really, really low, again, below 12.5. It's back below the 90% mark, though not quite to that. Remember, extremes down here is at 80%. We're nowhere near that relative to VIX 3M. In fact, VIX 3M is also extremely low. If you look at how low it is, down at 14, that's a pretty decently low level. It's the lowest level VIX 3M has been in quite some time. If I had to zoom out here, go to a weekly chart so we can kind of see it. Let's leave it on the daily chart. You can see you have to go all the way back. In fact, over here, these levels weren't quite that low, a little bit above that. And you can see even these levels here. You have to go all the way back over here. Sorry, there we go. To right before 2018, to most of 2017, the VIX 3M. That's a high level of complacency because this is 3 months. That means the market's really complacent about what can happen over 90 days, not just 30 days, which is what the VIX represents. So very, very extremely low. And we see that as well in the VVIX. The VVIX itself is still at very low levels too, down at 76. So not below 75 again, but remember, anything below 80 is extreme. Anything below 75 is really, really extreme. We're still down at these very, very low levels below 80. And that, again, would suggest that there is the possibility that we can get a jump higher in the VVIX. Again, if I were to zoom out a little bit so we can see some context on the VVIX and how it behaves. Again, you can see it just over the last 5 years, you can see it just rarely is down here, even at 75, much less 80, right, which is kind of up into this area right here. So it generally leads to a higher level of the VVIX, and when the VVIX is really low, it tends to lead to a higher level in the VIX itself. So we'll kind of keep our eyes on that and see how it impacts things going into this next week. So again, stream volumes that are already really low, extremely low volumes, extremely low volatility of the volatility index, including that really low VIX 3M, is just some signs of complacency that suggest that we might not get such a strong number on this current run. In fact, I'm in the camp that will probably be right around the 8 to 10% mark. Maybe a little bit higher because I kind of think we had this kind of move forthcoming. Maybe a little bit higher into 11, but I don't see us getting the strong typical rally of 12% plus. That's your typical intermediate run to the upside. That can avoid the larger than 38% retracement. In this case, almost a full 100% retracement down to the downside. Right now, let's take a look at what's driving a lot of this price action. You can see gold still has had a good 3-month return as the dollar's been pulling back, but so has international stocks. Look at those really rallying up a little bit faster than what we've seen from U.S. equities. Commodities are still relatively strong. Again, a lot of that thanks to what's going on with gold, and then bond yields are falling as bonds themselves rise off of their lows, right? So let's take a look at some of these asset classes on their own. We'll start off with the dollar index first, and you can see the big breakdown today down to the 200-day moving average. So that's a good break. A break below that 200-day moving average is very bullish, as you can see when we got down below that on the last fall, going into the end of last year when we had that strong rally. All right, so just continue. The MACD and stochastics are continuing to the downside. The market forecast, when you look at the market forecast for the dollar index, you can see is very strong short-term sentiment to the downside here. You look at today's numbers. This is starting tomorrow's already. So today's number, the intermediate line's down there. You can see the intermediate line. It's got a pretty decent opportunity to go into bearish territory here tomorrow, barring a significant run up to the upside. A bull tag that we have now busted through the lows of those bull tags. Even the first one, now we have dark pink shading and a red line. So bearish move. This has got an opportunity to start, again, a pretty decent run on the S&P 500, assuming this isn't any kind of fake out move to the downside. Excuse me. Let's take a look here at, there we go. The 10-year yield. You can see it also has broken below the bull tags. Doesn't have the red line yet, but it's broken below the lows of the bull tags. Sorry, I guess is a better way of saying that. And you can see very bearish short-term sentiment. The intermediate line is also in bearish territory. If you were to look at the 2-line version of this chart, TNX, you can see it also is close to breaking below its 200-day moving average. And again, a break below that would be very significant, as it would be very bullish for the markets. We haven't really had an extended move below the 200-day moving average for a while, right? We've gotten below that a little bit in early 2023 during the banking crisis. We got a little bit, we got below down there at the end of last year, and now we're potentially making our way below it here, where we might stay down a little bit longer. You can see if I were to look at the weekly version of this, you can see we barely got below the 50-week, both those instances, but we haven't made it to the 200-week, which would be very significant and most likely would coincide with actual rate cuts, right? We would actually be getting the rate cuts that would help drive yields. Because remember, stocks don't mind lower yields. What they don't want is a falling yield curve where the whole thing starts coming down, right? When the whole thing starts coming down, you can see there right now, all these long and intermediate term levels are all below the short term, right? These are more tied to the actual Fed funds rate. And I know a lot of people talk about this period being very similar to the 1994-95 period. The difference between 94 and 95 is the short-term yields never did get above. At the end of 94, when we finished raising rates, these short-term yields never did get above the longer-term yields up here. The 20-year and the 30-year still were at the very top of the yield curve. So not such a bad thing when it fell during 1995, because basically these long-term yields fell down to where the short-term yields were. That's not necessarily the case here. Again, we've had an inverted yield curve for quite a while. The short-term had been above the long-term for quite a while. Whenever that happens, like we saw over here for an example, when they were above. Once the whole yield curve yield complex starts to come down, that generally leads to a recession, as you see there. So we kind of want to avoid that. We don't mind the ups and downs here, but we want to avoid having everything, especially that short-term rate, start to drop. When I take a look at commodities, again, that third factor from an intermarket standpoint that's kind of impacting risk appetite right now. If you take a look at that, again, dark pink shading and a red line. We're below the moving average. Now, we haven't really dropped below this bull tag by very much. We did the next day, but then we've held that since, despite the fact that the intermediate line's below the 50th percentile, although not quite in bullish territory. It's kind of bottomed out here. In short-term sentiment, you can see near-term line, is still up above the intermediate line. So commodities are going to be really impacted by what happens here with crude oil prices. You can see its near-term line is up at bullish levels too, and that's going to really impact what happens with the yields, right? If you take a look at the two-line version of these moving averages, you can see that crude oil eventually still sitting on its 200-day moving average, and commodities are sitting right around between the 50 and the 200, haven't broken the 200 by a little bit because everything was below the 200 here, but not breaking below the 50. So we're still kind of converging, trying to figure out whether it's going to rally up to the upside. So strong moves. We'd really like to see the dollar break that 200-day, like to see the 10-year yield break that 200-day, and like to see this here break the 50-day. I think that would be our ideal scenario for equities to really continue this run up to higher levels. Again, we're banking on some strong support breaking, which might limit our upside here. But if it does break, then our upside would be a lot more unlimited. As you can see, the new highs and new lows spiked today, almost got up to 500. Big time moves. That's a good, strong move in breadth. In fact, if you take a look at the number of stocks above the 50-day moving average, we're flirting with getting above the 70% mark now, having crossed through the 60% level into bullish territory. Moving average is rising. It's not the greatest surge like we've seen other times when we've broken above the moving average, but at least we're above it, and the moving average is now rising. If you take a look at the skew is also back up above the moving average, and you can see looking pretty good. And one of the other things we look at quite a bit is the squeeze indicator. Right, we'd like to see the retail traders really gum up here, and you can see they are, right? The retail trader, remember, this tends to bottom out. The orange line, which is the gamma exposure that market makers have because of retail traders. That gamma exposure should bottom out when the markets bottom and should peak right around the time the markets peaked, right? So we peaked over here, but then we continued kind of with convergence mode, and then we made this leg higher. We finally peaked right there, and that ended up being a peak. Well, now our gamma exposure is already as high as it was then at that peak. So that's, again, another little bit of a red flag there, especially when you don't have, the big surge in dark pull buying that you typically get at the beginnings of this. You can see when we were at the beginning stages of this rally, the dark pull index got pretty strong here. At the beginning stages of this intermediate rally, the dark pull index was even stronger. And now we had a little bit of a run up here at these lows on the dark pull index, but now that we're rallying, the dark pull index is actually getting smaller. So it's not as much buying behind the scenes, so to speak, on this particular rally, as much as there's these extreme amounts of buyings from retail investors that are definitely not behind the scenes, much in front of the scenes. Let's look at the breadth here really quick on the McClellan oscillator on, let's see here, where is it? Here it is. On this indicator. So we're still getting, as I mentioned before, pretty decent breadth. The McClellan oscillator itself is not quite up here in like the 70s, 80s, where you really like to be when you're starting a bullish move. We're still kind of at lower levels. See, even this one you got up for a period of time, you got up to 95 there on that surge, 68 and then 95. So it's a good surge in breadth. When you started this intermediate rally, we got up to 86. So you like to get to these strong levels. This one you got up to, did get up to 100. And then this intermediate rally got up to 90. Well, the highest we've gotten up so far is 65. So we're not in the 80s and the 90s, which again, you'd like to see at least once to really complete the surge that we're pushing up to the upside. And part of the reason why is you can see today's move. I mean, utilities up 20% over a 3-month period. That is just a very, very strong move. In fact, if you look at the rate of change right now for utilities, we've been looking at this off and on, right? So we're going back the 18 plus 19, 20, 21 days now on this particular rise, and kind of a relatively short-term rise in utility prices, up over 15.5%. Just for some context here, again, that's pretty darn high. The only other highest period was coming off that COVID low, and you can see even some of these periods coming off the 2009 low, we didn't get 15.5% in that short amount of time. So very, very strong move in utilities coming off of this low point, much less coming off way over here. When you look at the run that we've been having, well, really since this low point here. The run that we've been having, which is now a 65. Let's see here. Let me just zoom in a little bit so I can see a little bit better. It would be 64 bars. So if we take a look at the 64-day move that we've had in utilities here, off of that low point, we are up over 21%. And you can kind of get an idea again. Let me just put a flat bar right there, right about the same level. Again, coming off that COVID level, and nothing else really even approaches it. Maybe this 2009 low point in June, but that's it, right? That goes to show just how strong a move utilities has been and continues to show when you look at it over here. Let's pull up the relative strength of utilities. So strong, well above the 50-day moving average. Strong. You don't have strong momentum, but you have strong relative strength, and you see this here as well when you look at it relative to the broad market. Again, you're still up above the 8-day moving average, and you're well above the 200-day. In fact, the 8 and 17-day, your 30 is about to cross above the 200 days. So again, it goes to show that despite the fact that technology had a really good day relative to the markets, it was pretty much limited. It was pretty much limited to technology. There we go. Breaking well above the 200 and the 50-day moving average. Big breakout. But that's pretty much it. You had this great move into the leading category in technology, but discretionary is actually continuing lower to the left, and communication services is not moving at all in the improving category. And so those are the kind of areas that you would like to see show some signs of improvement, so that we can really feel good about the bullishness of the market. We want to see technology and communication services and discretionary leading the way higher. Those are the three components of the Magnificent Seven, and you actually had three what a lot of times considered to be safety sectors leading the way higher, with your cyclical areas, including kind of your economic growth sensitive areas, materials, industrials, financials, all really lagging behind the market today on this strong run that we've had. All right, that brings us to our trade idea of the day, which is in the technology sector. I want to take a look at Applied Materials. If you take a look at Applied Materials here, it also got a cluster. Ended up with a near-term lineup above the 80th percentile. You can see it closed at new highs today as well. It got a yearly high today on an intraday basis and on a closing basis, as it closed above all these highs over here. Dark green shading in a green line, the intermediate line just crossing into the upper reversal zone. So strong bullish pattern there. You're going to see bullish patterns all across the board here. When you take a look at the weekly chart, you got higher high, higher Heikin-Ashi close, PPOs rising, the Heikin-Ashi differential above its moving average. When you look at the 3 green arrow chart, obviously you have 3 green arrows and a rising moving average. So that's a good sign coming into its earnings announcement here. When you look at the 2-line version of this, you can see we are well above the 200-day moving average, well above all these moving averages. Again, going into this earnings announcement here that is going to be after the market closes here tomorrow. So big breakout early before the earnings is actually released. When you look at some of the other oscillators, you obviously have a bullish breakout pattern here, up above 30, now below 20 on the negative indicator. Kind of looks almost exactly like the market from that perspective. The RSI and the CCI are at bullish levels, up above 150, up above 60 on the RSI. The Ichimoku cloud is also, you're well above the cloud now. The rate of change is positive. You're flirting with the weak bullish trend developing here. And then finally, when you look at the Bollinger Bands and the Keltner channels, you can see you're pushing up into the upper quartile of bandwidth, not quite pushing up against the band itself, but in the upper quartile, again, very similar to the markets. And then you can see closing above the upper Keltner channel with some really strong momentum there, and the bands themselves outside the Keltner channel. So what I decided to do with that earnings, I wanted to do a trade that was not so aggressive. So if I were to come down and take a look at the June trade, or these, excuse me, was more aggressive so that my risk was really low. Low probability equals low risk trades. So I wanted to do something here towards the low 20s on the delta here. Typically where I sell the calls for an iron condor spread, but in this case we're going to sell the call to try to reach that level at 240, buy the 230 for protection to keep my risk small. So we have a little bit less than a $500 risk and a $1,500 reward with a little bit of flexibility there. That will probably, I mean, this will be eaten up assuming if the earnings is off and the stock falls on the earnings, then we'll probably end up closing out the trade here on Friday. But if it does break out, then we have a pretty decent move and opportunity to get up to a pretty decent return for the very small amount of risk that we're taking on the trade. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link that's popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at marketscholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your Wednesday night, everybody, and we'll see you all next time.